The disclaimer, obviously I'll let you read that in your own time, but as I always say, because I know people come here for their for the stocks, especially because they're small stocks, as I say, it's very much general advice. So hopefully you've probably learnt by now that just because we say one thing doesn't necessarily mean it's true, and it's definitely not advice, so do your own homework. The NAOS mandate, and I suppose why, after 6 years, we've been listed now, we've had a LIC for over six years this month. While we're in existence, and this is really the base slide, the next two slides are anyway, of why NAOS is here and what we're seeking to do for all of our 8,000 shareholders. And the first one is really to protect investors' capital. Believe it or not, when we enter into an investment, the first decision or the first question is really not how much money you're planning on making over the next 4 or 5 years, even though it may make you feel good. It's definitely, well, how much capital am I putting at risk here, and what's the potential downside to any potential investment, whether it's through a balance sheet, the assets, or the industry that they operate in. Yeah, I suppose the upside to that is obviously we want to grow capital over the longer term. So through growing capital over the longer term, then hopefully through our results today, you've seen that we can grow dividends over the longer term as well. Profits or dividends are a function of profit. Pleasingly, our LICs have been able to build a profit reserve over the previous few years. So we've been able to maintain that dividend this half, if you haven't seen our results, which were released this morning. What truly sets us apart, and I'm sure hopefully a lot of you would agree, I get up here and discuss, our portfolios, which are very unique compared to many, if not all, of our peers. We run 3 LICs. We all have a focus on emerging companies, which is a very broad definition. I would say some of the managing directors and even boards of some of our investments are actually here today, so it probably makes my conversation a little bit harder than usual. But we invest in the very small end of town. So some of our businesses are 20 to 25 million in size. The average market cap in NSC is about 180 million. The average size in NAC is about $1 billion. Most people would call that small caps. So we really go to the nano cap end of the market, but we provide you hopefully with a concentrated exposure and a high quality exposure in that end of the market. We don't believe in owning 50 or 60 stocks, because we believe in the Australian stock market. Unfortunately, when I go through some of my slides, there simply aren't enough high quality businesses to build a portfolio of that size, let alone across 3 portfolios, which would result in a portfolio of over 100 positions. So as many of you would know, most of our portfolios only have 8 or 9 positions, and we very much believe in the longer term thematics of these businesses. And as I'll show in one of the slides, one investment we've actually had for over 6 years now, so almost day dot through NCC. We much prefer to build capital and compound returns as opposed to trying to trade the markets and pick the tops and the bottoms and whatever else. Our investment beliefs. And as I said, we really look for value with long-term growth. A lot of people ask us, depending on what investments you may have every year, some people say, well, you're a growth investor. Then we invest in a business like, say, a Saunders, for example, and people say you're a value investor. At the end of the day, in my view, I think they're both linked. You're really trying to find a business that represents value, but ultimately it's got to grow. If anyone here has run a small business or run any sort of business, you're trying to grow that business because you want to grow earnings, get a higher multiple, get higher value for that business, and hopefully grow your dividends. So we look for businesses that may look cheap today, or may not necessarily look cheap today, but they will grow over the longer term. We believe in quality over quantity, which I've stressed time and time again. We do invest over the long term, so we don't trade our portfolios. Anyone who's an NCC shareholder would understand that we haven't added one new investment now for 1.5 years, which probably makes people question, what do we do with all our free time potentially? But in saying that, we do believe that with our knowledge base, and I suppose in our detail in regards to some of the research that we do on these businesses, both with industries, ex-employees, ex-directors, unlisted competitors even, we feel that that knowledge is better being put to use by owning investment over many years. I've learned the hard way time and time again that, if you look at CSL, I always use the example of CSL. If you try to trade in and out of that, you've probably lost more money than you would have by just owning it the whole way through and letting your returns compound and compound over many, many years. Performance versus liquidity. Obviously, because we run 3 LICs, 99.5% of our money is locked away. So obviously, investors can't redeem their money. They've got to sell it on the stock market, which some people obviously like or not necessarily like, depending on the market. But what that allows me and my team to do is make an investment purely based on the investment fundamentals. Many fund managers, as you would know, if you invested, say, $10,000, they take your $10,000, put it into their fund gets bigger by $10,000, so then they'll go and buy, I suppose, an array of stocks based on their liquidity and whether or not they think they're good value. That doesn't work so well in small caps because when everyone takes their money out, and I went through the GFC, and at one stage we had a flood of redemptions. Basically that means you've got to sell all your small stocks at the same time, and it becomes very hard to do. So basically fund managers, in my view, probably tend to protect their brand a bit more by investing in more liquid stocks that are more index focused. So you're going to get more index-like returns, as opposed to us where, I suppose we're willing to put our neck out a little bit more by investing in the smaller space in probably more unique opportunities that are definitely more illiquid, without a doubt, but hopefully they provide a much better or superior long-term return for all of our shareholders. We don't follow the index, as all of you would know. We only invest in industrials. I did get the comment last year that a lot of people didn't know we have quite a stringent ESG focus in this fund. So we have quite a strong exclusion criteria, so we don't do materials, which I know some people frown upon. Some people obviously like it and some people not so much, but we have clear exclusions around tobacco, gambling, nuclear weapons, things like that, coal mining, even iron ore mining for that example. And oil and gas companies. And the reason why it works, I think it's twofold. Clearly, we have a very strong ethical following, but more importantly, or just as importantly, it really allows us to invest in businesses that we can understand, or we like to think that we can understand. We're definitely not experts in valuing everything, so we want to invest in simple businesses that I can get through to my shareholders on even just one piece of paper, for example, because if I can't get it across to you, then chances are we're really probably not going to know what's going on and what's driving that business ultimately over the longer term. And finally, management alignment. Clearly it has been a poor year for the NAOS funds. Clearly I'm probably hurting just as much as everyone in this room because all of my funds are invested in the NAOS funds. I don't own a stock outside of NAOS. And that's how we treat our own investments. So a lot of our investments, as many of you would know, are founder-led businesses in some form or manner. That means they have a lot of skin in the game. They own a lot of ordinary equity. They're not necessarily incentivised through large salaries and short-term bonuses. They live and die by equity and dividend payments, and that gives us some comfort that ultimately they're making the right long-term decision for their business, albeit it may not be the best short-term decision for the share price. The market review. Obviously not something we do all the time, so I've tried to make it quite simple in this case, and it goes over just a couple of slides. But I do highlight the point, and a lot of people don't realise this. Obviously, January was a strong month for equity markets, and February's been shaping up to be another strong month. But on the 31st of December, for the fourth quarter of calendar year 18, it was the worst negative performance, or the worst performance for the small ordinaries, especially the industrial small ordinaries, since the GFC. And a lot of people don't realise that. I went through the GFC and I remember a lot of businesses down by 30, 40, 50% in a very short period of time. It had almost felt like that again towards the end of calendar year 18, albeit it has bounced back very quickly. A chart that really highlights, in my view, I suppose, how the market has changed and what the market is looking for is a business called Afterpay, which I'm sure lots of people in this room would know, maybe even use. And it's a business that really has been in vogue for probably a couple of years now. They provide, you can't call it credit because it's not credit, but basically they allow you to, say, potentially buy a t-shirt, say the t-shirt's $100 and you pay it off in 4 equal payments without paying interest, but you're allowed to take the t-shirt from day dot. Obviously the idea is to target people like me, being the millennials. In saying that, this business is obviously, it's not profitable, it's very capital intensive because they require the funding as their book grows. And it's really based on getting more and more users, more and more retailers. They're expanding into the US, they're expanding into the UK. And ultimately, in our view, it's driven by low interest rates and really a race for hyper-growth businesses. You can see halfway through the year, the share price almost halved at one stage. And that was really driven by a peak in US interest rates, which I'll get back to on the next slide. Then you can subsequently see in late January, everyone's talked about, in the US, for example, they're saying, we're not going to raise rates as fast as we can, or as we have been. And in Australia, everyone's talking about the next rate cut. And then all of a sudden, equity sentiment changes and everyone's looking for the next hyper-growth stock because you can't get the same return in term deposits or Telstra shares or whatever it may be. So everyone's looking for higher growth stocks that I suppose can outpace very low interest rates. Value versus growth. clearly, if you look at our portfolio and you do want to, I suppose, pick value or growth, we've arguably been a little bit more value, even though I obviously don't like to talk about it too much. But the most interesting point when I get to the next slide is in that correction towards the end of the year, it was really value that underperformed. And you would probably talk to a lot of fund managers, maybe 70 or 80%, and everyone would have said, well, with a market correction, we would have expected the hyper-growth stocks to come off the most, but it wasn't the case. And I can give you plenty of examples. You would know plenty of examples. The downgrades came from, the building materials space, the retailers, anything affected by a Royal Commission. And it was the value stocks that really came off the most, and obviously that hurt our performance as well. And then that last point, obviously, I've touched on, which in January and February, pleasingly, you've seen our portfolios pick up, but unfortunately, at the same time, you've seen the index pick up at a very, very quick rate. Just four key points that I think really cover some of the, I suppose, the highlights or the lowlights in 2018. And some of these points they don't scare you, but I think they really make you look at some of the risks you're taking when you invest in equities or bonds or property, for that example. To give you an idea, 80% of all loans issued to corporates in the US were covenant light. Basically, that means you had very few covenants or very few restrictions on what you could do as a business in regards to taking on that debt. That's a rather scary figure when you see it was actually much higher than in 2007 when the GFC was just around the corner. To overlay that with the fact that at one stage rates in the US actually doubled in 2018, even though they've clearly come back more recently, if you think about the amount of leverage and gearing and lack of restrictions and covenants together with higher rates that can move very quickly, you can see serviceability issues coming up in regards to business being able to maintain and service that debt. Exchange traded funds obviously have gone from strength to strength and obviously put a lot of pressure on active managers such as ourselves, especially when the index goes from strength to strength, because obviously normally a rising tide lifts all. But what I do say to all of our investors is, in our space, ETFs are almost, probably non-existent, because they just can't operate in this space. There's no liquidity, the companies are too small. ETFs need to operate in a space there is lots of liquidity and lots of demand and the ability to get in and out quickly. And in our view, that's probably also why you're seeing valuations move up in that larger end of town, because there is a lot of demand for them through ETFs. ETFs now are some of the biggest shareholders in companies today. If you look at BlackRock, for example, they are some of, if not the largest holder of many US stocks, and also in Australia today. And then finally, small cap underperformance. Yes, we did underperform, and we did underperform the index, but small cap underperformance was significant relative to their larger counterparts. And the anecdotal evidence I will give some people in this room, and I know some people in this room are within the industry, but a lot of fund managers are actually getting out of small caps in general. They're definitely getting out of micro caps. When we launched NCC and raised the small amount of 17 million 6 years ago, we were almost one of three that went to sort of this level or this end of the market. You've had a lot of fund managers over the last 4 or 5 years that have started small cap and micro cap funds thinking it's quite easy, the performance is good, it's something we should be doing for our brand. But I think a lot of them have realised that they run much bigger businesses, and the brand reputation and the risk and the resources it takes means, it's probably not for us, and we want to move up the liquidity curve. I can't tell you how many month-end reports I've read from competitors saying, we're just getting out of the micro end of the market, we're going up the liquidity curve because we're not happy with the risk. But clearly that's a macro risk, and a risk from their business because they're worried about redemptions and liquidity profile, as opposed to us where we're still happy and we'll always invest in this end of the market and give you a pure exposure to that end of the market, even though it can be volatile from time to time. Clearly, everyone's talking about the Australian economy. We've gone through a period of, I suppose, significant negativity, especially towards the end of last year. And this chart is the business conditions that are released by NAB. This has been updated more recently. But you can see towards the second half of last year, and many of you who obviously have some exposure to the Australian economy through running your own business or your own investments, there was a notable slowdown in certain industries towards the end of the year. Clearly, some of those affected us. Some of you know some of our larger holdings, and I can go through some of the examples. But the three examples that really, for us as a business, that we got wrong on a calendar year, I suppose, 18 view were, building materials was a big one. Anyone who's a Boral shareholder would have copped 3 downgrades through the year. Adelaide Brighton, another big business downgraded towards the end of the year. Lend-Lease have had issues if you're a Lend-Lease shareholder. And the theme they all have is demand's actually quite good, especially in infrastructure, as I'll show you. It's just the pace at which these projects are being done and completed. It's slower, it's harder, it's more expensive. There's plenty of work around, but there are lots of delays. But even so, it did affect earnings for calendar year 18. The consumer discretionary space, it's very black and white. We've gone through some reporting. If anyone's I think it's City Chic, is a small cap retailer that sells women's wear. The stock was up 40% yesterday for a retailer. But at the same time, you've got issues in regards to some other business where there's a lot of market scepticism around businesses like Myer, JB Hi-Fi, Adairs, how some of these business models can handle disruption from the likes of Amazon, online sales and whatnot. And general just malaise in regards to consumer spending. Everyone's talking about consumers are very much tightening their wallets. They're not willing to spend on some of these more discretionary items, but it's interesting to see that we've gone through just the start of reporting season, and a lot of the results have actually been a lot better than what people think, because expectations are so low and people are still spending on some of these smaller items, and even in the case of JB Hi-Fi, some of those white good items. And then the big one that obviously cost us a significant amount in regards to our holding in Japara in the aged care space was regulatory issues. Regulatory issues really dominated 2018 and dominated obviously January of this year. You've had the Royal Commission in regards to the Hayne Royal Commission. You've had the Royal Commission into aged care, which started last week. And you've had a lot of knock-on effects in regards to some other spaces. So the ones that I pulled out is the automotive industry. If anyone's gone to acquire a car and look to get a loan, it has changed a lot from what it used to be just 2 years ago. There's a lot more pressure and regulatory issues on dealerships, how they can take your loans, creditworthiness, what they're looking for. If anyone's tried to get a mortgage lately, the amount of detail they go through on your expenses. I was talking to someone, they download your 3 months worth of transactions, and they'll even pick out things like Uber Eats, how many times you get an Uber, and they'll use that against your credit score, not your credit score, but the amount of money that you can borrow. So it's becoming a lot more sophisticated, and it's slowing down the amount of, I suppose, loans that financial institutions can get through. But at the same time, we think it's throwing up a lot of opportunities for some smaller players that can be more niche operators and operate in industries where there are significant markets where the banks can't operate because they've got compliance issues, I suppose vertical integration issues and whatnot. A chart that many fund managers put up, and I suppose it's a chart that might confuse some people, especially when you've seen the growth in the Australian economy, but this is the household savings ratio, which has been in pretty much a permanent decline since 2010. So it'd basically tell you that people are living off, I suppose, increased equity from either shares or their home or their house prices or whatever it may be. But I think the one overlying factor for me, and what we see from a lot of our micro-cap investments and just speaking to a lot of clients, is just the lack of wage growth. People haven't received a wage increase or a salary increase in a long time. But what we are seeing and what we see is in some industries there is definitely wage growth coming. So if you're a civil engineer, for example, you're in high demand because of a variety of issues. If you're in the technology space or you're a software engineer or whatever it may be, you're in extremely high demand because of obviously some of the large tech firms, NBN, for example. There is wage growth coming, and a lot of employers tell us it's very hard to find quality staff unless you want to overpay for them. So we believe clearly there is wage growth in the economy, but at the same time, if you're in retail, for example, you're obviously not putting through wage increases, so it's offset somewhat. Offsetting that is obviously interest rates on mortgages. I know for myself through NAB, I copped a out-of-cycle mortgage increase 2 weeks ago, and it does affect a lot of people. It affects confidence, it affects people's willingness to spend from a consumer point of view. And then obviously with a lower dollar, the price of imported goods doesn't help the Australian economy, especially the fact when we no longer have, such a strong manufacturing industry as what we may have had 10 years ago, where we could, export some of these goods. Clearly it helps the material space, but in regards to manufacturing, it's almost non-existent these days. Everyone, asking the question, well, what are some of your lessons from the last 6 months? And I think we obviously, as a team, we took a good hard look at ourselves. For me, it was my first negative year of performance since being listed. And you like to think it'll never happen, but eventually it does. And you really need to look at some of the investments that you made and some of the decisions you made as a team. And we highlighted this chart, and forgive me because the MD and CFO are actually in the room of this company. And this is CML Group, so CGR. It's our largest investment in our micro-cap portfolio, one which you would know has been in our business or in our fund now for 4.5 years, maybe even a bit longer. This is a business that operates in the invoice financing space. I'll give the example that, if you deal with Microsoft, for example, their payment days are often very long because they can do that to a lot of their suppliers. But ultimately that means you don't have the cash flow to pay your staff and grow your business. So you'll go to someone like a CML or a ScotPac or a NAB, depending on who you want to use, and they'll provide you with the cash up front for a fee based on that invoice size. It's very big in the UK, and it is becoming much bigger here because a lot of businesses need that cash flow to survive and to grow. This is a business that upgraded twice through the year, and you can see through the year, based on just a total shareholder return, it was flat. I suppose we look at it and say, well, we're in our best position from a business point of view. It gives you a flat share price. It doesn't give you a whole lot to go on when we've had some poorer investments towards the tail, which I'm more than happy to go through. A lot of people overlay the fact, well, what's driven that? And it's really been driven by a few things. And I suppose that first point is it's very much a catalyst-driven market in my view. Everyone's looking for the next upgrade, the next, I suppose, quarterly results, subscriber numbers, whatever it is, especially in that big end of town because it's liquid. No one's interested in that micro-cap space. Everyone, I suppose, views it as an event to sell stock. Capital allocation decisions and market communication by small caps. If you follow some of our investments and you see some of their releases, you could probably understand some of my frustration. They're hard to understand. They're opaque. They're not transparent. It wouldn't make anyone want to buy the stock. You'd go and spend your money on something else. And clearly we want that to change. And pleasingly, we've seen that change in some of our bigger investments. A proactive approach with management teams. It's a big one. We're some of the biggest shareholders in some of these businesses, as you would know. We have a 23, 24% stake in a Nero Group, for example. We have very large positions in a couple of businesses that are here today. We always say we're not an activist investor. I have no interest in being an activist firm. But at the same time, businesses are run for shareholders, and I think decisions need to be made for shareholders' considerations over the longer term. So if we can assist management teams do that, if we can assist management teams in regards to board composition, even capital, how it's used, even if capital is required, then we feel as long as the business is making the right decision for shareholders over the longer term, then the share price will eventually react. Share prices tend to be the last things to change, unfortunately. And then obviously market scepticism around short-term earnings gyrations. I think you've seen this very much in regards to reporting season over the last sort of 10 days. I gave you the example of retailers. There's a lot of market scepticism around in regards to small cap earnings. If you lose a client as a small cap business and you only have revenue of 50 million, well, that can affect your business a lot. It's part and parcel with, I suppose, the investment universe that we invest in. If you lose a key staff member, if you lose bank funding, it can really shake your business. So people don't want to have that allocation to that end of the market. At the same time, though, you can find those, I suppose, those jewels of businesses that can get through these situations, that can develop a service or an offering that has a clear competitive advantage, and they can grow a revenue base from 30 or 40 million to 400 million. And they're the investments that can really drive your performance over many years. And ultimately, that's what we're looking for. Clearly, I suppose the first few slides are, rather gloomy. But in saying that, we're here to invest, and anyone would know that, a lot of people come up to me and say, well, NCC and NSC are fully invested. And the reason why is I'm going to give you 4 or 5 quick slides on why we're invested in those businesses, but more specifically, some of the industries we see are growing fundamentally in the Australian economy, even though there is some clear weakness in the economy. We still think there are some parts of the economy that are going very well and have a clear tailwind over the next 3, 4, 5 years, and we want to have exposure to that. Because I think we've very much learnt the hard way over the past 6 years that you can invest in a value business, but if that industry is fundamentally flawed or there's some structural change, it's very hard to make money. I'm sure some of us have all made that mistake. Something looks too cheap, even though it operates in a bad industry. I can tell you, because we are concentrated and we take quite long-term bets, we really want all of our investments to be in industries where at least there's no headwind, but there is some tailwind, because it makes it a lot easier for a business to grow. The first one, which we've been talking about, and a lot of people tend to frown upon, is NBN. I know it's very topical with the Telstra result. I know Andy Penn, obviously, making his comments heard yesterday about NBN and some of the structural issues it faces. But regardless, NBN's being built. And a lot of people don't realise that NBN, in regards to the amount of connections, the connectivity, the amount of people in this room that will join up, is forecast to hit its peak this year and next year. And what that means is there's a lot of maintenance and a lot of external workforce there of 24,000 people that needs to connect people. In our view, it's not the connections that matter so much. We give the example that if a Labor government gets in, they're talking about fibre to the curb, fibre to the node. You know, they want to get rid of a lot of the copper. That's even more billions of dollars, I think. And in the next slide, one of the slides, I think NBN in total is, forecast to cost, close to $50 billion. So if we're going to start making technological changes, it's even more money. And once the thing's up and running, it's not so much the cost to get it up and running, it's the maintenance cost that people really do underestimate. So this thing will be up for many, many decades even. So the cost to maintain it is significant. To give you an example, the Telstra copper network cost over $1 billion a year just to maintain prior to Telstra selling it off to NBN. So it gives you a rough idea of the scale of what people will be spending just to maintain this network. And clearly we have exposure through ServiceStream and BSA, both of who are on the panel to help with that build and maintenance. The big one which I mentioned is infrastructure. Unfortunately, this slide's been updated last week as well by CIMIC, the largest contracting business in Australia. And it's interesting, in their comments, they said the short-term pipeline has decreased because of delays. But in saying that, we've moved our chart, the CIMIC chart, the new one, out to 2025, and the outlook there is increased by 30% over those 3 years, so 2023 to 25. That's huge figures. You're talking 30% on 15 billion each year. And they're saying the pipeline has never been bigger. Even on the Boral call that we listened to, even though it was a downgrade, Mike Kane, the CEO, said, we've never seen so much infrastructure work all at the same time coming towards our business. So the work is there. It's clearly just slower in regards to an execution manner. And I just wanted to note some of the, cause I'm based in Sydney, so I've been going around telling everyone about how much money Sydney's spending here. That's actually not in this chart. So obviously we're all based in Sydney. The Western Sydney Airport's not in there. It's another $5 billion. NBN, $51 billion, not in that chart. The two potential tunnels we might build here, the Second Harbour Tunnel, the Northern Beaches Tunnel, if that ever happens, is potentially another $14 billion. The Olympic stadiums, which has been another very topical subject, and the stadium in Paddington, another $2.5 billion. And then Snowy Hydro, which is another $6 billion. And then you overlay the fact, which we didn't put in here, is that Melbourne's actually forecast to overtake Sydney in regards to the amount that's spending on transport infrastructure over the next 12 months. There is so much work around that, in our view, people just won't be able to cope, and there will be delays, but there will be a good backdrop of work. And even more so, the point we like to make is, just because the example we use is North Connect. So North Connect's a new tunnel, it gets built, it's delayed, obviously Lend-Lease have had issues, but it's actually the maintenance of that project that's key. You need to maintain the fire systems, you need to maintain the lighting, the electrical systems, the ventilation systems, because of all the regulatory issues. Someone needs to do this work, and it is a lot of work, and it goes for many, many, many years as long as that asset is operational. So it's not just a one-off hit, there's many years of work behind it. Agricultural products. I'm sure many of us have potentially lost money in the agricultural space, or the listed agricultural space. But in our view, listed companies operating in this space have definitely evolved. It's not the same MIS schemes of 10 years ago that clearly people lost a lot of money on, a lot of faith in the sector. But two charts that we've highlighted. Obviously, we're a big shareholder in Wingara, which export oat and hay and straw. And we've also recently picked up a position in Costa Group post their I suppose, downgrade last month. And to highlight some of the leverage and the thematics behind these businesses, you can see Australian hay exports from 1990 to today. Clearly there's been volatility, and one's only year to date, but you can see the long-term trend. And the trend's really based off, a lot of these countries, as they develop, there's demand for milk. Dairy cows need oat and hay because of the fibre and the protein content. Because Japan and South Korea don't have the land mass to produce a lot of these commodities in scale, they rely on parties or countries like us. But they want quality and they want consistency of demand, hence why these thematics play out over many years. And then citrus exports to China, which were non-existent in 2010, and then today they're over 90,000 tonnes alone. And then you talk about Costa developing facilities in Morocco so they can sell, so they can grow berries, sell them into Europe in the off seasons, when necessarily berries aren't able to be produced in those regions, so they can command a higher price in those so-called shoulder seasons. It has developed the space. Another business we look at is Webster's. They're a big walnut producer, for example. People are taking much more longer-term views. They're trying to corporatise these businesses, become much more sophisticated in the way they handle the environment. And I suppose the weather is obviously a big issue, but they do develop into what we believe are great long-term assets that are very hard to be replicated. The non-bank finance sector, a chart of credit card applications, accounts actually, sorry, I always say applications. You can see since 2017, it's taken a knee-jerk down. I can tell you a lot of my friends and people we know, credit cards aren't what they used to be. So what does that mean? People need new forms of financing. We've seen through those recent transactions, Scottish Pacific, which is one of the largest invoice financing businesses in Australia, was acquired by Affinity Equity Partners, a private equity firm, in 2018. KKR, you would know, acquired Pepper Group, I suppose a non-conforming lender, in Australia in 2017, and KKR competitor Blackstone bought an 80% share in La Trobe Financial, which is an unlisted financial services business. They're not buying these businesses just for one product. As I was having a conversation with someone before, ScotPac just did invoice financing. Now it's under the ownership of Affinity. Now they're getting into equipment leasing. If you're Pepper Group, it used to just be home loans for people who may not have a 9-to-5 job employed by a large corporation. They'll employ the people who are they'll give a loan to someone who's self-employed, may not tick all the boxes. They may get into leasing, credit cards, home loans, car loans, because they understand the bank has very little appetite to lend to certain people who may not tick the box and be a pure, plain vanilla sort of applicant. And they see the amount of pressure the banks are on in regards to compliance, getting rid of funds management businesses, splitting businesses up. They won't have the appetite nor the staff to grow their businesses, and they see this as a very large opportunity, and so do we. And obviously we have a share in a 20% stake in the largest financing broking network in Australia now, which is COG, I won't say the whole name, CML Group, which I've mentioned, and then the 360 Capital Total Return Fund, which just does short-term lending to developments. I give the example, if you're building a hotel in Perth, the bank will not give you the money to do that anymore. They will give you the money once it's up and running and it has a yield, but you need to find financing from somewhere who's willing to take the development risk, even if you have a great track record over 20 or 25 years, prior to it being operational, and that's where TOT fits in. And then the last one, cybersecurity. So we have a holding in Over the Wire, which reported yesterday. I won't go through all the points, but as a business, I'll tell you, we have 8,000 shareholders. If something happened to that data, if there was a privacy issue, we have to now report it to the government. It is a real issue for small business, especially when you're dealing with a lot of people's data, and especially a lot of it which is private. And 50% of SMEs don't believe they can handle that, or they have the right services to handle that issue. I can tell you, as a small business, when we obviously needed to change our systems and get a firm to handle this for us, we couldn't go to a Telstra because Telstra's not interested in our $5,000 a month to cover these. They're interested in $100,000 a month. They can't provide you with the service to do this. Now we actually use Over the Wire. They can provide us with a security service for our emails. You get two-factor authentication for even your mobile phone. They back up all your devices daily to the cloud. They handle our cloud. They give us internet backup. But more importantly, they give us one invoice and they give us one help desk. So you don't need to go through 5 different help desks for 5 different services or get 5 different invoices and try and reconcile them. It doesn't sound like much, but when running a small business, and I know some of the businesses they're talking to, it is significant, because everyone will tell you some of the biggest issues running a business is obviously, some people will say obviously new clients, HR, whatever it may be, but a big one is IT and cybersecurity, and it's one that's definitely not going away. Just to finish off for me before I get Rob to talk about the performance and the stocks within the fund, this is really just a checklist of, I suppose, clearly last year was a challenging year. The way I look at it is, clearly 5 years before that we had much stronger performance. In NSC we haven't had the privilege of having that fund for long enough, so it's only been 1 year of poor performance. But this as a team really looks at, well, what are we doing about it? I think even though your performance can be poor and you say, well, some of your stocks are down, that doesn't necessarily mean that makes them good investments or cheaper investments. You really need to try and optimise your portfolio to make sure you have the right investments for the right time with the right valuation metrics. As I said, a lot of people ask us, well, what do you do with your time when you only have 25 positions? And to give you an example, we now use services. We can talk to a lot of ex-employees. We can track an ex-employee down, ask them about the business, ask them about the staff, some of the industry dynamics. We get a lot of, because of our large shareholdings, we get a lot of unlisted competitors speaking to us. As I said, we have a large shareholding in Wingara. A competitor spoke to us obviously last week, just obviously speak about the industry and what they're seeing. You tend not to want to have too many of those conversations because they're always going to be inherently negative. But it gives you a very good idea of the industry dynamics and what everyone's seeing and how people are reacting. And hopefully we feel through that information we should be able to put together some conservative long-term assumptions that make the right investment decision over the longer term. And then through investing in industries that have tailwinds. Most of our businesses, as Rob will show you, are lowly geared. So if it does go pear-shaped, and it has gone pear-shaped with a couple of investments, they are net cash balance sheets. They do have property on the balance sheet in some cases. They're not beholden to the NABs and the CBAs of the world. They can get through the tough times and reinvest. Because I think I learned through the GFC, it wasn't so much losing the money in the GFC, it was the businesses that went out the back door and didn't come out that ultimately cost you. So it was how you came out of the GFC and how you put capital to work. That's where you made your money, and that's really how you proved your ability to shareholders. So with that, Rob's lucky enough to talk about the performance and 6 of the businesses within the 3 funds.
Good morning, ladies and gentlemen. Firstly, thanks very much for coming along today and showing your support to the NAOS team. We very much appreciate that. I'm just going to touch on, as Sebastian mentioned, 6 key stocks, what's happened for those stocks over the last 6 months, why we like them going forward. I'll then touch on the topic of performance, which no doubt will be interesting for you all. And then I'll touch on how the portfolios are currently positioned, I should say, and give you a few metrics around that. So to start off with, CML Group. Look, Sebastian's touched on this quite extensively already, so I won't go into too much detail. But what's kind of happened with that business over the last 6 months that I can add is obviously they've upgraded their earnings at the AGM in October. But a key thing is they've improved their management team. They brought in some global experience into that team, and we feel that really stands them in a good shape going forward. Why we like it over the medium to longer term. So CML Group in the invoice financing space has only been competing in a very small part of the total market, about 10% of the wider market. They're moving up now, up into the 90% the other type of the market, and they're competing, what's key is, against the same competitors. So they've done a very good job competing against Scottish Pacific and the banks in the smaller end. And we see no reason why they can't eke out a little bit of a much bigger pie in the bigger end of the market. So we think that'll play out over the next couple of years. Moving on to Enero there. Enero is a marketing and PR business. Some of you might know it was the old Photon Group back in the day. It's gone through a lot of change, and it's now very much firing on all cylinders based on the last result. What's happened over the last 6 months, which I think is really key, is they brought in a very high caliber additions to the board of directors. Some global experience again, some very high up marketing chiefs at the likes of Virgin, Wendy's and Callaway Golf out there for the golfing enthusiasts. And we think going forward over the next 6 to 12, 18 months, that board has got very much ample experience in being able to make acquisitions and integrate acquisitions, which I think is very key. Tailwinds for that area is PR. Any publicity is good publicity, as they say. That might not be true for the individuals in the publicity, but certainly true for a company like Enero. Their core kind of assets within their business that are growing very well are PR assets. They're in the US, and that's a very big market, and they're only a very small fish in that market and doing some good things. Moving on to M&F Group, which is one of the largest positions within the group that we've ever held at the moment. And it's a business that we've known for quite some years. I might just use an analogy because it's quite a confusing business to some. I might just use a quick analogy to describe how we look at this business. And we look at it like an infrastructure play. So if you think about a toll road provider, someone builds a toll road, and then anyone who wants to drive a car on that toll road has to pay a fee to be able to use that service. M&F Group is somewhat similar. They built an infrastructure of a voice network, the best voice network in the Asia Pacific region. And anyone who wants to have their mobile number or any sort of phone number housed within that network has to pay a fee every time they want to use that phone number. And there's a very wide use case for any sort of phone numbers out there. The last 6 months, again, a lot of movement and underlying improvement within the business that hasn't showed through in the share price, in our opinion. The last 6 months, key thing there is they've made a very key acquisition of what was a customer and also a competitor at the same time. It was a competitive bid, so that was a bit of noise within the market late last year. That's all sorted now. They've got that business within the company. And why we like it over the medium to longer term is A, they can integrate that business hopefully successfully and create some group synergies. But B, it's more their customer base. Their customers are the big global software businesses, the likes of Google, Amazon, Facebook, Skype. These big businesses are somewhat of a communications arms race. And anything they do within the Australian market benefits M&F Group, because they're not trying to pick a winner. We're not here to pick a winner out of who's going to be the best software company out there. We want to be able to benefit from them using that toll road. So that's why we like M&F going forward. Moving on to COG, it's the largest equipment finance aggregator within the country. And the aggregation business model is well understood by the market and has been very successful in other industries such as insurance broking. And it's topical at the moment, but it has been a success in mortgage broking as well. The last 6 months for COG has been quite significant. Again, they've made 4 acquisitions that all bolster the overall group, and they've made some very key management and board changes as well. Most notably, they brought in the old CEO and co-founder of Pepper Group, who has great experience in the aggregation space, to be the chairman of that group. Going forward, why we like it, Sebastian touched on it quite extensively, all this infrastructure boom that is happening. Doesn't take a genius to look outside and you can see a delayed road just off George Street there, or any sort of crane out there. All that comes back to someone like a COG, whereby you need finance for this if you're going to try and put a truck or an extra crane on the road, or on a project, I should say. That needs financing. An easy place to come is someone like COG. Moving on to BSA, and the way I like to think about BSA personally is I like to think about it as Service Stream's little brother. And Service Stream's been a very successful small cap business in the field services area, and BSA has got a lot of similar attributes, yet it's also got some differences as well. The last 6 months for them has been quite a period of instability for the business, because the underlying assets and the underlying operations have been going very well, yet there's a non-core loss-making area which is causing a lot of market time and skepticism about the rest of the business. The management team's done quite a good job, and we feel there's an update coming in some sort of capacity at the half in terms of what they're going to do about this loss-making division going forward. Because if you strip that out, the underlying divisions are going very well. If they can redeploy that capital within the business, that's upside for where we see it at the moment. Trades on a very significant discount to Service Stream, and it benefits very heavily from the NBN rollout, but then secondly, the maintenance. And that's the real key. The maintenance part is not going to end on any certain date. That will just keep going and going and going. And BSA are well positioned for that, being a contractor to the maintenance part of NBN. Finally, Wingara. As Sebastian mentioned, it's a hay processor and also a cold storage freezing business for meat carcasses when they come off the abattoir and head up to Asian markets. The last 6 months, they've made a lot of progress. They've improved the return on assets out of their blast freezing business, which they bought back in March 2018. And they've also increased the capacity of their hay business by 3 to 4 times. So it's been a lot of significant work, despite a TSR over the last 6 months of relatively not much. Why we like it going forward, they're well positioned for that Asian food bowl theme, which Sebastian talked about, so I won't dwell too much on that. I'll skip over the Howard Marks quote. You can read that in your own time, but we always like to put one of them in because he's an idol of all of ours. Coming on to the topic of performance, and I'll caveat, there's been an updated version of this that's gone out to market for the January numbers earlier in the week, so they'll be more updated than what we've got here. We're the first to admit the last 6 to 12 months has not been good performance, and given we're largest shareholders in terms of the management and board, we feel it as much as everyone else. I will caveat though, a lot of progress, as I've just touched on with those 6 holdings, a lot of progress has been made in the underlying businesses of what we hold, yet the share prices have not adjusted accordingly. And that's a very much a facet of micro cap investing, small cap investing. Things do lag in terms of the share price versus the performance of the businesses. It's been an opportunity for us to buy more at lower prices of some very key holdings of ours. For instance, we've been able to buy more of one of our largest holdings at a very depressed discount to what we think is fair value. So yes, we're disappointed. Yes, we don't want it to happen again. We're feeling it as much as everyone else, but the underlying businesses we feel are in a good position over the medium to long term. This is just a chart. It's on the information sheet you've got in front of you. But I guess what we're trying to demonstrate here is for NCC and NAC, which are the two LICs we've been running for the longest period of time, we want to show that we've been able to generate outperformance, but also at a lower downside deviation or lower risk than the market. And we've been able to demonstrate that over the medium to longer term. Yes, short term there's gyrations, but the medium to long term, we hope that can continue. Coming on to the portfolio specifically, I'll just caveat as well, there's some numbers on the right-hand side there. They're all our internal projections, so by no means anything to rely upon. And it's our internal projections of the underlying businesses within the portfolios over the next 12 months. We don't give our top 10 holdings. That would be particularly stupid in the case of NCC because we've only got 9. So we're trying to give you as much transparency and understanding of what we're doing without giving you obviously the stocks. And Sebastian often comments in the month-end reports about all the businesses that we hold, and I've just commented on 6. So you can get a really easy feel for what we hold, but we're just not going to put it into paper. And despite having 9 holdings, and generally we're one of the most, if not the most concentrated fund manager out there, and we think that's our key. We still do see 300 odd plus companies a year, whether they are listed, whether they're industry, unlisted comparables, ex-employees, anything we can do to build our information advantage and understanding of not only our core holdings, but anything around the edges that we're still looking at as well. So we're not just sitting on our hands with 9 holdings in each fund. Cash weighting there, obviously 0, and it's very low in NSC as well. We feel that your dollars and our dollars are better invested over the medium to longer term in what we hold. If that changes, we can hold up to 100% cash. Significant director holdings there as well, and that's a key theme across all 3 LICs. As you see there, market cap of 80 odd mil. This is very much a true micro nano cap fund. So this is very much down the smaller end of what people invest in. Despite that, we're able to pay a dividend yield out of that, and I've had many questions on this already. The dividend yield is the dividend of the underlying investments within the portfolio. It's not the dividend yield of the LIC itself. So that's a key thing to say there. EBITDA there, and what we're trying to show is we can get earnings growth, relatively unlevered or pretty much minimal leverage within the companies that we hold at a relatively cheap valuation. I would say that 36% seems very high. It is skewed by one particular company. If we strip that out, it's about 25%. I won't dwell on too much on NSC, all to say that it is relatively similar in terms of the metrics there. I would say that the directors have been buying on market since we've taken over that vehicle and have publicly said that we will, one day hope to be one of, if not the largest holder within that vehicle. So you've seen the directors buy on market, and I'm not here to give guidance, but there's no reason why that can't continue over time based on what they've previously said. Again, similar dividend yield, a little bit higher EV to EBITDA multiple based on the fact that the stocks are slightly up the market cap curve. And again, with NAC, a much higher cash weighting here. We've deployed a reasonable amount of cash into some new positions. Sebastian touched on Adelaide Brighton as one. So we're finding opportunities out there in things that stick to our key industry tailwinds, especially after the kind of market gyrations in late last year. And with that, I will hand back to Sebastian for the appendix. Thank you.
I think it's worth noting that when Rob put those slides up for stocks, you could see TSR. TSR stands for total shareholder return. Clearly a thematic through all of those positions, bar one, was they've had very strong 3-year performance, but a very poor 6-month or 12-month performance. Clearly we take the view that those management teams have been very consistent previous to this, and obviously they've gone through periods of poor performance, but if any, and I'm not saying it is an indicator because people will hate me saying this, we believe that they can continue to perform as they have done so over the longer term, even though the last 12 months has clearly been poor for 5 of those 6 businesses. The appendix, I'm going to probably get through this as quick as I possibly can because it's more of, I suppose, a fact-finding mission. Most of you all know this information. I'll try to cover off on some key points though. So key point being the dividends. Obviously we announced a dividend this morning. The point I would say here, and not too many LICs release this information, but our dividend reserves is $12 million. That equates to roughly 2 years, 4 quarters, we would say, of retained earnings that we can use to pay out a dividend. What that means is, as someone came up to me before, if we continue with our negative performance, hopefully we don't, we can maintain the dividend for a couple of years. But it is important that, we have put enough away, thankfully as a board, to pay a dividend in this case of poor performance. We don't pay it all out. We do keep some in the kitty, and pleasingly they have been fully franked. Clearly for this fund to fully frank a dividend is much harder to do because we've got to pay tax, which means we've got to realise gains. But even so, we have managed to do that reasonably or very successfully over the previous 6 years. NSC, obviously the newest of the 3 funds, it's gone to a quarterly dividend, which was released this morning as well. Obviously, it's been fully franked as opposed to being 50% franked under its previous name. This one has about 1.5 years of reserves, with a healthier franking balance relative to NCC. And NAC, obviously gone to quarterly as well. NCC is the only one that's semi-annual. Once again, about 1.5 years, and franking, once again, is healthier for this because it's operates in larger businesses, more liquid businesses. We can really, I suppose, track down those franking credits easier than what we can do in a microcap fund. And for all of you who are wondering if I'm going to comment, yes, I will comment on the potential for changes to franking credits and how it affects us and our 3 LICs. I'll just do that at the end at question time. Just more of a visual representation of, everyone asks, well, I got an email, I was in Perth actually, and someone asked me, well, what 3 LICs would you invest in? And actually I didn't recommend any of ours. I recommended someone who's actually in this room, I just realised. And then 2 others. With the point being, I actually got an email after that saying, thanks very much, Sebastian, appreciate it. I bought all 3 NAOS LICs, so no pressure. But I think the key point to get across is these are how they are different. A lot of people ask us. NCC, as you can see, invests in the very small end of the market. This is all based on market cap. NSC fits in the middle, and NAC is towards the end, but not in the top 50. We don't invest in the top 50. We leave it to people like you and your advisors. We don't feel like we have a proper competitive advantage in that space. But ideally, the perfect investment is to see one in NCC and let it go all the way through to NAC because it's been a success and obviously developed into a much larger business. This slide really just highlights a lot of people, people appreciate concentration. I do get comments that some people don't appreciate concentration. They prefer more stocks. But this really just highlights the thought process behind it. And a lot of people don't realise this in the Australian equity market. There's 2,800 stocks listed, and then I can get rid of an awful lot of them for you very quickly. So companies under $10 million, there's 640 of them. So essentially not investment grade because they're too small. Revenue, so companies without revenue after that, there's another 345. Companies that operate in industries that we won't invest in. Obviously, we're a very strong mining equity market with a large mining contingent, and gambling and whatnot. There's 900 of them in there as well. And then companies that in our view don't have the cash requirements to last as a business, so they're really just shell companies or they need capital in the short term, there's another 498. So that leaves you with the wonderful world of 411 businesses which you could potentially invest in. Based on our view on management valuation and ESG, that gets down to 50 to 80. The point being of what I'm trying to get across is there are very few quality businesses that you can invest in the ASX. And the point that I make to everyone is if you're a large cap manager, a lot of large cap managers find it hard because if you've underperformed, probably the reason why is because you haven't owned CSL. CSL is really our only exposure to healthcare in the top 20, for example. If you want to invest in cybersecurity, you want to invest in IT companies, software companies, even just manufacturing industry, for example. Good luck trying to do that in the ASX. And it's a real shame in my view because a lot of the quality businesses get taken off the boards through takeover, mergers, acquisitions, and you're left with a much smaller bunch of higher quality businesses, hence why people probably look to invest offshore from time to time to get that industry diversification. Our ESG framework, which I've touched on, clearly those exclusions are significant, but in our view it doesn't affect our performance. Even taking it the next step further, we believe it allows us to invest in businesses that have much more sustainable business practices and operations over the longer term. I gave the example recently, a contracting business we invest in, they have to their first 2 female project managers, for example. And according to the MD, they're doing the best job or performing the best he's ever seen out of his entire team. Even how companies relate and interact with their community support, getting support from local customers and things like that. In our view, it is a very big deal. I use the example of a NEAR or PR business. If you want to look after 750 staff under the age of 35, it's no easy feat. So it's about being able to attract the right staff, giving them the right support structures, the flexibility. All these things are very positive and important for small businesses. And finally, just shareholders. Pleasingly, that even with the poor performance, we were able to add shareholders in NAC and NCC over the past 12 months. I don't see any other fund manager releasing this data, and maybe people don't feel it's useful, but I do believe it's useful because we are willing to come out here and speak to all of our shareholders and not hide away. So hopefully we can continue to grow that chart over the longer term. It hopefully shows we're doing a good job. Investor awareness and communication I'm not going to touch on because I'm sure you know the million ways you can stay in touch, or the one way that which you can unsubscribe to everything if you so wish. And then finally, just an important point, we've appointed a new director after quite a long time of searching. Sarah Williams, who's in the front row, not to embarrass her, but recently joined us, had our first board meeting yesterday. More importantly for me, and the support it gives me, and hopefully some of the things I can learn from Sarah, is Sarah was an executive director at Macquarie, ran their IT business in regards to the IT infrastructure and their funds management business. And I can tell you, as part of a growing funds management business, it's more and more important each day. So it's a valuable addition, extremely valuable addition to our board, and another independent director. And for those of you who don't know, we continue to give back over 1% of our revenue, not profit. So NAML, the manager, is not yet a dividend-paying business, unfortunately. But we continue to support these 3 charities. Hopefully, as we continue to grow, this is the manager, so obviously it's not your money, it's our money that we get through the fees that you pay us. We continue to support these 3 businesses or charities. In the case, the Royal Flying Doctor Service in South Australia and the Northern Territory is the most recent one. So hopefully as we grow, as I say, I'm always looking for suggestions I get all sorts of suggestions, of any potential projects, programs or organisations that we can support as we become hopefully a larger organisation ourselves. But obviously thank you for your support, appreciate it, and hopefully we can be back with some better performance figures in 6 months' time. So thank you.